Hello everyone, welcome to the first week's lecture on the quantitative trading strategies. So this is the first week's lecture, and we're going to cover the basics understanding and concepts. So first, what is quantitative trading? Right. So this is also called algorithmic trading, right? And it refers to the automated trading strategies or trading activities that generates two types of signals, which is first one is to buy or sell, right? Second one is to sell particular instruments. So it can be called financial instruments, securities, or assets, right? Based on particular algorithms. So let's we're going to talk about what is an algorithm. So now, what is a good strategy? A good trading strategy, which can be simple or can be complex, right? So it involves buying low and selling high. So imagine this is the stock price, right? So if I purchase the stock at this point and then sell it at this point, so this is the margin and this is the difference. And I make money by buying at a low point and selling at a high point. So this is called a buy, which means I long a security, right? So buy means long, and sell means short. So how do I make money? By selling assets. For example, I purchase so here and then sell it. Sorry, it should be the other way around. So I sell it at this point and then purchase it back. So this is called shorting because at this point, I don't have any security yet. So, but I can borrow it from someone else, right? So this is at this price. And at a future point, if I know that if I predict this asset is going to decline in price, then when the price drops, I can buy it back and then return the asset to the original owner of the assets, right? So this is how we make money by selling high and buying low. So this is called shorting a security. Of course, the quality of the trading decision relies on two things. So one is the sufficiency of the input data. So we need to have the data to be able to build a good model. The model can be simple, can be complex, but it relies on the input data to be able to train it. So the model needs to learn. The second thing is how good is the model, right? How robust is the model? Does it only work on history, but not necessarily on the future, right? So we need a bit of back testing. So there are four types of financial input data. So let's look at them one by one. First one is market states, which describes the overall state of the market. For example, it can be the price movements in the form of tick data. Right, so what is tick data? Tick data is the minimum unit of price movement. So this is, for example, if 1 cent, right, this is 1 cent is our unit, then could be from the $1.01 to 1.02, 1.03. So this is our tick data, and each price level we can have different volume for the stock. So this type of data measures the movements in the price of the security, right? So you can either it's moving up or down along the units, along the ticks. It can also be the market-specific factors such as the bid-ask spread. So later we're going to talk about in the second course, in the second week's course, we can talk about what is bid-ask spread and in the context of limit order books. So the second type of data is financial news. So it can be textual data, right? So it comes in the form of text. It can be news, can be reports, earnings conference call, transcripts, etc. Right. So this is harder to analyze, but it's well people derive a lot of analysis. Right? Fundamentals. So fundamentals means can be a few things. Can be overall economic or sector specific conditions, right? So there's overall economic conditions, and it can also be firm specific metrics such as revenue, cash flow, earnings per share, right? So how well the company is doing, and how well the overall market is doing. So that is so-called fundamental analysis. It can also be technicals, which falls into the field of technical analysis, which means that we're going to use the raw price data in the history, and from there derive a set of technical indicators to be able to tell is the price gonna increase or decrease, right? So these technical metrics could include moving averages, stochastic indicators, how variable it is for a given period of time. Right, so these are the 4 types of financial input data. And the overall process of quantitative trading is like this. So at input level, we have different data that comes in. And this is the engine we have. So the engine takes some inputs, takes some data, and then it's gonna learn, right? It's gonna train itself. So this is falls into, for example, the machine learning, where we train a machine to or model to learn from the data, find the pattern, and then it outputs a decision, right? Whether we're gonna buy an asset or sell an asset. So that's the overall process. And we can look more closely at the model development workflow. So typically, as we mentioned earlier, it starts with some training data, right? And this training data comes in usually in the form of inputs, output pairs, right? So inputs, I can say this is X, and the output, this is Y. So X can be a historical stock price, the market indicators, right, firm specific indicators, or anything, right? So as long as relevant features, we can pass into the model. The outputs is the targets we want to learn. So, for example, the price movements, whether it goes up or goes down for a particular day. So what we would like to do is to say, we want to find a function f, right? So a function that's actually takes the inputs x, right? And then predict an output y. So this is y hat, which I use the hat to indicate that this is a prediction. So which means that if I can find a model that's good enough, then I can pass in the data, which is the market indicators, then use this to predict, for example, tomorrow's market movements, whether it's going up or going down for a specific asset. And of course, this is our prediction. This is our target with true label. So, for example, when we are at tomorrow, we can review the label and then can say what's the difference between the truth and the prediction. And then we can say how good is the model. So this model we sometimes call it a mapping function, which essentially takes an x, right, goes to the model f, and then outputs a y. And so it's called a model, right? And it should correctly maps given inputs to the corresponding output. Let's look at the model development workflow in more detail. So here, these graphs contain a lot of information. Just to highlight a few important components. So we start with some training data, which, as you know, comes in pairs, right? Input features and target labels. And one thing I want to mention is that the model itself, which is F, it contains 2 components. The first one is the parameters, right? So what are the parameters, the free parameters that the model can use to learn, to optimize, right? So we have small model where there are only a few parameters, and we have, for example, big models like the big deep learning models where there could be billions of parameters. So it represents the how powerful a model could be, right? And also the other sets of the other components architecture. So with these little parameters, right, and how are they gonna connect with each other and also connect with the input data so that it's so this is a model F, right? We have the input data X, and then so this architecture sort of defines how the information flows from X, right, the inputs into the model, and then there are some complex calculations, which is really not that complex. It's all mechanical, right? And then outputs a Y. So this is Y. So this architecture it defines the flow of information, right? Flow of data. And the output is usually what you call a prediction by heads. And with the prediction, with the Y, we can take these two to produce a cost, which tells us how far off we are from the truth, from the targets. And then we're going to return it back to the optimization algorithm so that it can learn the model and especially fine-tune the weights. So these parameters, the value is going to change, right, based on how big is the cost. So our goal is to minimize the cost, right? So our prediction should be as close to the target. That means we need to reduce the cost, minimize the cost, and that means that this is achieved by adjusting the parameters, right? And of course, the architecture itself is usually defined in advance. So we typically do not adjust the architecture during the training process. Okay, so that's overall model flow in a nutshell. And let's continue. So institutional algorithmic trading is usually comes in a large volume, right? So we have large models and we need to break it out because if we suddenly execute a lot of models, then one thing is we may not have enough demand or supply in the markets. And even if we have, it's going to cause a change in the price. It's going to fluctuate the market, right? So, so we're going to usually break it down into smaller ones, right? To reduce the execution risk, which is which I was referring to. So it's we may not be able to execute the large orders, right? And usually comes in anonymity, right? So we do not review the information of the investor or the trader underlying the transactions. So that we can control the impact of the trade on the market. There are several things that can happen. So one is slippage, which is the price difference between the intended price and the actual execution price. So if I want to transact sell at $1, right? But when the transaction happens, the actual price may not be $1. It could be higher, it could be lower, right? So this is called a slippage. And so such large orders usually executed in the dark pools, which are private exchanges, right? Who can handle this large volume. And usually it comes in the form of iceberg orders, meaning it's although what we see is small size orders, but underlying there's a so what you see is this portion, right? Small size orders, but underlying there's a lot of other orders that come in this big order. Okay, so let's we're gonna look at some codes to specifically look at how to choose some orders randomly from a list. So that's more on the programming side. Just one more note on how to be a quant trader. Of course, we need good mathematical models, understanding, and the ability to do quantitative analysis, right? But also we need the soft skills as well to handle high pressure, right? So usually it's going to be a high pressure environment. Okay, so this is the last slide of this first section of this lecture. So, okay, we're going to look at major asset classes and derivatives. So, a derivative, by meaning is it means some financial instrument, some assets that depends on some other assets, right? So it's derived from some other assets, which is more fundamental, more basic. So these are all tradable financial instruments, which means they can buy or sell in the market. It's public or private, right? So you can enter long or short positions, which is another way to say you can buy or sell. So buy means we enter a long position for a particular asset, and sell means we go short in this position. And the asset can be in combinations as well, right? So it can be single, it can be combinations. It can be profit seeking, which means we want to make some profits, or more for risk management, which means we want to hedge some risk. So here I have put in some common asset classes and derivatives. So let's look at them one by one. The first one is the stocks. So stocks are also called equity, right? This is a form of security that represents sort of the proportionate ownership of the underlying company, the issuing company. So if this is the total shares, and then if you occupy maybe 10 out of 100, so total is 100, then you own 10% of the company. So this represents ownership, proportionate ownership. And so how do you make money? So there are two ways. One is the stock price goes up, right? Then your ownership, the corresponding value goes up, right? So that's one way. The other way is to receive the dividends. So if you own some stocks, there may be some regular or irregular dividends from the issuing company. All right, so there's fluctuations. Bonds is more stable. It belongs to the fixed income debt instruments, which means now the company wants to borrow some money from you, and then you lend some money, and then you just take the which is called fixed rate coupons, right? You collect the coupons, or it could be variable interest payments. And also, by the time, for example, if you lend the money to the company for 10 years, then by the end of 10 years, you will collect the principal back. So you have the interest and you have the principal, right? So this is a fixed income asset, and which is more stable, but usually it's less risky, right? But also the corresponding return could be less than the stocks. So annuities, it's more falling into the insurance contracts, right? And it's usually from the financial institutions, insurance companies that provides a fixed income stream. So this is also a fixed income stream to the contract owner in the future. For example, I want to, so when I retire, I want to get $2,000 every month for my retirement life. Then this is a product I can buy, right? So usually, so we usually purchase them for retirement purpose, right? So because it provides a guaranteed stream of payments in the future, right? So it's um, not necessarily definitely long, or so it could be depending on the type of product. So it could be a specific period. When I retire after 60, it could be 10 years. Every month it gets 2,000, or 20 years, or even for the remainder of the life, right? So it depends on the type of the product. All right, so now let's continue the cash and equivalents. So these are very liquid. So because cash is the most liquid form of asset, and it's usually very short term, right? Usually less than 90 days. These are investment securities with low risk and low return, right? Because it's very short term, and the return is not going to be very high. So it could be the bank accounts, right? We deposit money in the bank and we can collect some interest, which is not very high. And it could be the near-term or short-term instruments like the US Treasury bills, which is very stable, but return rate is not very high. Or money market funds, right? Money market funds also falls into the type of cash and equivalents, where the short-term and also low return, low risk. So, of course, the most obvious feature is that it's easily accessible, right, anytime. And it reflects the firm's ability to pay short-term debts, right? So if I have a lot of cash or equivalents, then I can pay the short-term debts easily, right? Right. So next one is commodities. So it's the basic goods, right, such as raw materials, raw inputs to produce other goods or services. It can be in the form of gold, oil, or natural gas, right? And they can be traded in the spot market. Spot market means the cash market where we can just trade with the actual commodities. And it can also be used in the derivatives markets like the futures and options. So now let's then look at those features. So a futures contract or futures derivative, right? So basically it is a contract that allows the investor, the buyer or the seller to to engage in the transaction, right? To either buy or sell at a specific date in the future. So this is today, this is the future, right? So I can fix the price P, right? So for example, I want to buy the asset at 100 per unit. Then I can say when I'm at maybe 1 year later, I can still buy at 100 per unit for the assets, right? So this is pre-specified assets, and in terms of the price and the amounts and the future dates. So this again hedges the risk, right? Because the price will fluctuate. It will fluctuate in the future, and we do not know either it's gonna go up or go down, and by how much. So with these futures contracts, we eliminate the risk of highly fluctuating prices for these assets, right? So it can be used to hedge against the price movements, right? Okay, and there's also forward. Forward is basically similar to futures. The only difference is that futures are traded in the exchanges, but now forwards are traded usually in the OTC or over the counter, so which are decentralized marketplace where people trade directly with each other without engaging a central exchange or broker, right? So the transaction is more direct. All right. So now moving on, we have the options. So options are another type of derivative product, right? So again, we are looking at here, and so this is current dates, this is now, this is the future. So with an option price or option contracts, we can at a future date buy or sell an asset, and this gives us actually this gives the ability, right, the option to buy or sell. With futures, we have to do the transaction, right? So we have the obligation, but with options, we have the option, right? So we have the choice to buy or sell the assets at the expiration dates. So this is called expiration dates, or before, right? So it depends on the type of option. So basically, they give us the rights, right, to not obligation to either go long or go shorts in the for the underlying assets. So people usually use them both for hedging, right? You can use option for hedging, or you can use options for speculation. Depends on which direction you want to go. So okay, so that's options. Currencies is the international currencies or can be currency derivatives traded via the global electronic markets, right? So it can be called foreign exchange markets or forex. So basically, it allows investors to exchange one currency for the equivalent value in another currency, right? So exchange currencies at the current market rates. So traders can also speculate on the direction of the currency movements, right? So basically more to profit from a favorable price movement of this pair of currencies. Right, so now next we have the ETF or exchange traded funds. These are more of a portfolio of securities. This is a pooled investments and can be a basket of securities like stocks, bonds, or commodities. And they can be treated like regular stocks because they are baskets of securities. Then they're considered sort of a safer, right, lower risk, and than regular stocks. Next, we have the REITs. So REITs are called real estate investment trusts, right? So this refers to the companies that actually own, operate, or finance the income-generating real estates. For example, they own a building, they just rent it out and then receive the rental income, right, on a continuous basis. So they have the steady income stream from the real estate investments, and they do not necessarily have to purchase, manage, or finance the actual properties themselves, right? So this is a type of product we can consider. Mutual funds. So mutual funds are also a portfolio of stocks, funds, or other securities, right? So they are also a portfolio. but they can only be purchased at the end of each trading day for a calculated price. So this price changes, and it's called net asset value. So every end of every trading day, we're gonna recalculate and then have a new net asset value. Okay, so lastly, we have the hedge funds. So as you already know, hedge funds, they are more high frequency. They are more higher risk, high return. So usually they tend to aim at earning above average returns for the investors, right? So they have a wider range of trading strategies, and they charge a fee, right? So they usually charge higher fees than the conventional investment funds. All right, so that's it, and thanks for watching. I'll see you in the next video.